Good afternoon, everybody. Welcome back to the Opportunistic Trader. I'm sorry, good morning. It is just after 10:30, and we're joined by Alan Hell. Alan is the lead consultant at Treasury Consultancy. He's been joining us regularly to talk currencies, Brexit, and a lot of different interesting topics. How's it going this morning, Alan?
Yeah, I'm good, thanks, Mike. Yeah, the connection's not great. I hope you can hear me okay.
Yes, I do hear you perfect. Sorry about that. You can't hear me that well?
No, you're breaking up, to be honest. Yeah, I'm over a long way away, but yeah, I can't hear you very well this time.
Let me see if this is a little better. Well, if you can hear me, tell me what's going on. Let's start
I
with
can hear you now. Yeah, that's much better.
oh, okay. So tell me, let's start with Brexit and move into FX. What's going on with the latest on Brexit into year end here?
Well, the great news is that Parliament's broken up for Christmas, so there is there is a little bit of respite in the I don't know, to want a better word, childishness that's been going on in the last week or 10 days in Parliament. It's been just completely farcical. People have got to the MPs have got to the end of their resources, as it were, with regard to what's going to happen next. And I think it's becoming clearer that the choice is becoming more and more stark. It's either well, I think we can all accept that the agreement that's been um, put about by Theresa May and agreed with her between her and Brussels is dead. I mean, that isn't going to ever be passed. So we're left with two very opposite ends of the spectrum, as it were. On the one side, we have Leave, which basically is while it's not happy to for the UK to leave with no deal, it sees no deal as the best opportunity right now for settling along the lines that they require. While you have Remain, which is kind of favouring a second referendum, but again, that's not going to happen because Theresa May is so against it. So they're favouring a revocation or revoking of Article 50 of the just withdrawing the application to leave the EU. So we have those two very widely differing views, and with, to be frank, nothing really in the middle. And that's what's going to be the difficulty, because as things stand right now, the UK leaves the EU in just less than 100 days on the 29th of March, and nothing is in place to stop us leaving with a no-deal scenario. Now, of course, we had the Bank of England meeting yesterday, and one of the big losers over Brexit, funny enough, has been Mark Carney. I mean, the governor of the Bank of England. He has consistently been very well thought of by the UK during the entirety of his term, until he started getting involved in Brexit. And he clearly it favours Remain, but whether he favours Remain from a personal point of view or the fact that it will make his job that much easier is difficult to actually ascertain. But either way, the Bank of England yesterday warned against a no-deal Brexit, which is it's going to cause havoc in the UK. We're talking about anything between 6 and 9% drop in GDP, if we believe everything that the Remain camps say. From the point of view of the Leavers or the Brexiteers, it's very much a case of, well, we're going to have a tough time for a year or 18 months, and everything will be swimming because we'll have trade deals with everybody and his wife and the EU trying to deal with us. So it's such a wide-ranging argument at the moment that it's very difficult to see anything being settled before 100 days' time.
But there's a vote in end of January scheduled at this moment, right? Are you expecting that to be pushed out?
Well, the vote on the 14th of January will take place, but that is only on the acceptance or otherwise of the agreement that Theresa May has negotiated with Brussels, and it's very clear that that will still get voted down. There's no there are something between 50 and 80 Conservative MPs who will vote against it. The opposition will vote against it. The entire opposition will vote against it, and so will the Irish Unionists, who are the people propping up the government at the moment. So that's a dead duck. That isn't going to fly at all. So as I say, we're left with no deal or revoking Article 50 right now. They are the two options left if you discount the deal.
What are your thoughts on
And
pound?
both of those.
What are your thoughts on the British pound itself and price action? We're right now at 126.50.
I think that well, I don't see it below 125, and I don't see it above 127.50 for the moment. I think the bias is very much to the downside, although clearly the surprises are all ranked on the positive side, as in there's very little more bad news that could come out for sterling, which will push it lower. But if there were to be any kind of positivity, then we would see the pound rally quite quickly, because there are a lot of weak shorts out there who would get out quite quickly, either to see what happens, or to look to get short again once the buying was over. This is a very similar in microcosm to what's happening with the euro and Italy right now. There has been a draft agreement between Rome and Brussels over the Italian budget deficit, and the euro's rallied on the back of it, but it hasn't gone very far because there are other issues for the EU and the euro which will continue to drive that lower. But going back to sterling, I'm more worried about the way sterling is going to react against the euro for the same reasons. I mean, we're getting very close to the 90 level, or 110 if you look at it from a sterling euro perspective. Euro sterling is just below 90 now, and it can if it breaks through there, then I think there will be some real heavy follow through buying, because that has capped the euro for quite some time now. So sterling under pressure, but not really going very far. Certainly not before the 7th of January anyway.
What other opportunities are you looking at in FX?
I'm looking at, as I say, I'm looking at the euro. Euro, possibly euro yen, I think looks quite bid. I'd like to get long of that a little bit lower down. A euro dollar, same thing. I think the one of the big things that's going to happen going forward is the 4th of January's December employment report is going to be quite critical, given the FOMC meeting this week. I think if the employment report is weak, as in less than 170,000 new jobs, and the November number doesn't get revised upwards too much, then I think the dollar is going to suffer, and I think it will be the euro that becomes the beneficiary of that. So I'm looking for this resistance at 114.80, 115.20 to be tested, providing the employment report is not super strong.
Yeah, that'll be interesting after the new year. Long way away, but I guess business days, it's not that many days away with the holidays of both Christmas next week.
No, we haven't got. Yeah, sure. Unless there's some major, either some major event or some large M&A activity between through the holiday, then I think we're pretty much at the levels we're going to be at for year end, to be quite honest.
Yeah, especially with the volatility in the equity markets, I'd expect some gyrations. Get to this point, less liquidity, sure, but at the same time, certain corporates or people have to get done. Then also potentially get an equity book, and you have their redemption based on other performance, have to liquidate positions. So there could be some movement purely on that. Nothing fundamental.
Yeah, of course, exactly. Yeah, sure. Yeah. There's one question.
Sure.
Sorry, Mark, there's one question I wanted to ask, because I saw the other day and it confused me a little. In the wake of the FOMC meeting, I saw I read a comment. I asked the guy who wrote it what he meant by it, and he never came back to me. So I'm not sure he was embarrassed or what. But he said to me, he said in his comment, the equity market, I think it was a tweet actually, the equity markets reacted dramatically to the FOMC report, but report, whatever you want to call it, result, while the FX market didn't, because the FX market fully expected what happened. Well, surely the equity market fully expected the Fed to do that as well. So why was there such a major difference?
Well, exactly, and we did talk about that. Theoretically, the equity markets supposedly had a 100-point range that day, closed on the low, traded lower yesterday because the Fed, the Fed moved to more tighten, or basically keeping two tightening prospects in next year. But I agree that FX, if you take a look at if that was such a hawkish event, dollar actually weakened, which you would not expect. So they definitely were telling different stories. I think it just goes to show you that equities are focused on a few other things.
Yeah, and the same thing today. I mean, we've seen the dollar strengthening today, and we had pretty poor data out. I mean, the durable goods wasn't great, and Whatever, I can't remember the other thing that came out today, but either, there hasn't been some great data. The dollar's strengthened, so it's a difficult one.
Yeah, I think it has a lot to do with liquidity and potentially also the market. The reason why maybe euro went higher is because the market was heavily short euros and long dollars, and so unwinding of everything, taking off their equity position, equities are plunging, and taking off their long dollar position, despite what the FOMC. So that also could be a part of it as well. It's just more of a positioning.
Sure. Yeah. Of course. Yeah. Okay. Yeah. That's what. That's basically, as I said, Brexit is taking a bit of a breather now until Parliament comes back on the 7th of January. Clearly, there will be some moves behind the scenes. The Brussels have been very, very certain that the deal that's on the table is the only deal that's going to be offered. So we can't expect Theresa May to be rushing off there anytime soon to create a breakthrough, as it were. So we deal with the cards we've been dealt, and we carry on from there, I think, into the new year.
Absolutely. All right. Thanks for the thoughts on FX and Brexit. We'll definitely keep an eye on it. This is Alan Hill of Treasury Consultancy. We'll talk to you soon, Alan.
Thanks so much, Mike. Have a good weekend.